Welcome to the Deep Dive. You're here because, well, you want to get smart fast without getting totally bogged down.
Mm-hmm.
Today we're diving headfirst into what many consider the Bible of value investing. Benjamin Graham's The Intelligent Investor.
A classic.
Yeah, this book dropped way back in 1949, and Warren Buffett himself called it by far the best book ever written on investing. Pretty high praise, right?
Absolutely. It really set the foundation. So our goal in this deep dive is, to pull out the essential wisdom from Graham's work.
Okay.
We want to give you a clear understanding of his core principles so you can make smarter investment decisions and, crucially, steer clear of those common mistakes, the ones that can really hurt your returns.
Exactly. And whether you're already managing a portfolio or maybe just starting to think about investing for your future, Graham's ideas are just timeless.
They really are.
We're going to crack open the real difference between, smart investing and risky speculation, get our heads around the crucial idea of a margin of safety, and meet the unforgettable Mr. Market.
That's a great one.
So where do we even begin with this classic? It's pretty dense.
Well, Graham starts with a really fundamental question. Are all investors the same? And his answer is a clear no.
Okay.
He identifies two distinct types, the enterprising investor and the defensive investor. Understanding which one you are or maybe lean towards is really the very first step.
Right, enterprising and defensive.
Mm.
Okay, what exactly does each of those look like in practice? Break it down for us.
Sure. Think of the enterprising investor as someone who approaches investing like they would a business venture.
Okay, hands-on.
Very hands-on.
Okay.
They're willing to put in the significant time and effort needed for thorough research, in-depth analysis, and actively managing their investments.
Right.
They see it as something that requires their ongoing attention and, real commitment.
That sounds like, serious commitment.
Mhm.
What about those of us who have day jobs and, kids, other things taking up our time?
And that's most people, right? That's where the defensive investor comes in. Graham recognized that most people simply don't have the bandwidth, the time, to treat the stock market like a second career.
Makes sense.
So the defensive investor, therefore, aims for a simpler, more hands-off strategy. Their focus is mainly on preserving their capital and achieving, reasonable returns without needing to constantly monitor and tinker.
Right.
The key insight here is that Graham tailored his advice. He acknowledged these different levels of investor involvement, which was pretty forward-thinking.
Yeah, that makes a lot of sense for most people I know. Now, one of Graham's core messages, and you mentioned it earlier, is the crucial difference between investing and speculation. It might seem obvious, but he draws a really firm line in the sand, doesn't he?
He absolutely does. For Graham, true investing is grounded in rigorous analysis, like
Right.
serious homework.
Hmm.
It means deeply understanding the value and, just as importantly, the potential risks of an asset. The primary goals are, 1, protect your initial investment safety of principal, and 2, earn an adequate return over time.
So it requires work.
It requires doing your homework, yeah. Focusing on the fundamental strengths of the business behind the investment.
And speculation, then, is, well, it sounds a lot like gambling, maybe.
That's a fair way to put it, yeah. In Graham's view, speculation is essentially making investment decisions without that solid foundation of research and analysis.
Doping.
Pretty much. Speculators are often swayed by market trends or emotions, fear and greed, or just the hope of a quick buck. And, that significantly increases their chances of losing money.
Right.
The key insight here is that investing is about informed decision-making, while speculation is driven more by hope and chance.
He even suggests having a small mad money account for speculation, but with some pretty strict boundaries, right?
Right.
Like keep it separate.
Exactly. He advises limiting any speculative activities to a small, designated portion of your overall investment funds. He suggests maybe no more than about 10%.
Okay, that's small.
It is, and it's absolutely critical, in his view, to never mix those speculative funds with your core investment capital. Keep them mentally and, practically separate.
Yeah.
The actionable takeaway is really just be conscious of whether you're investing or speculating in any given decision and manage each activity, differently.
And there's that really powerful quote that gets right to the heart of his focus on the actual businesses. What was it again?
Oh, yeah, it's a great one. Graham stated it very clearly. Stocks do well or poorly in the future because the businesses behind them do well or poorly, nothing more and nothing less.
Simple, but profound.
It really is. What's fascinating here is how directly he links stock performance to the underlying business fundamentals. It seems obvious, but people forget.
All the time.
Yeah. The implication for you, the listener, is to focus on the real value being created by the company, not just the noise of the daily ups and downs of the stock price.
Speaking of price movements, let's dive into Mr. Market. This is one of Graham's most brilliant ways, I think, of explaining the often crazy behavior of the stock market.
It's fantastic. What's so insightful about Mr. Market is how Graham personifies the market's volatility. He asks you to imagine you own a small stake in a private business.
Okay.
And every single day, your partner, this guy named Mr. Market, comes to you with an offer. He'll either buy your stake or sell you more of his, always at a specific price he quotes for that day.
Right. And Mr. Market isn't always thinking clearly, is he? He sounds a bit manic.
Precisely. That's the point.
Yeah.
Some days, Mr. Market's valuation might seem pretty reasonable. Maybe you're reflecting the actual performance of the business.
Sure.
But on other days, he's driven by pure emotion like wild optimism or deep pessimism, leading to prices that Graham famously described as a little short of silly.
A little short of silly, I like that.
The key insight is that these emotional swings, these silly prices, don't necessarily reflect the true underlying value of the business at all.
So the smart move isn't just to react to whatever Mr. Market says that day.
Not at all. Graham emphasizes the importance of developing your own independent assessment of a company's worth, based on its fundamentals, its real value.
Your own homework again.
Always.
Yeah.
You should only transact with Mr. Market when his offers are exceptionally advantageous to you.
Okay, so buying low, selling high, basically.
Exactly. Selling when he's irrationally enthusiastic, maybe offering you way too much, and buying when he's overly fearful and offering things cheap. Otherwise, Graham says, it's best to simply ignore his daily pronouncements.
Just ignore the noise.
Yeah. The actionable takeaway here is to try and use market volatility to your advantage, rather than letting your own emotions get dictated by Mr. Market's mood swings. Reacting emotionally to market drops turns Mr. Market's potential gift-cheap prices into a curse for you.
Yeah. Easier said than done sometimes, but a crucial point. Now, we often think about obvious dangers like market crashes, but Graham also shines a light on a more subtle threat, almost invisible: inflation.
Yeah, this raises a really important question. What is constantly chipping away at the value of your money, even when the market seems fine?
And the answer is
Inflation. Over time, the purchasing power of cash steadily declines. That same dollar just won't buy as much next year or 10 years from now as it does today.
so just holding cash isn't safe long term.
Exactly. It makes holding too much cash over the long term actually a losing strategy in real terms.
That's that money illusion he talks about, right?
Yeah.
Where we focus on the numbers, the dollars, but not what they actually buy.
You got it. We tend to focus on the nominal gains, the raw numbers in our bank accounts or investment statements, rather than the real inflation-adjusted returns.
Yeah.
What can that money actually purchase?
He had an example, didn't he?
Yeah, a great one. Getting a 2% raise when inflation is running at 4%, it feels like progress, right? More money.
Sure.
But in reality, your purchasing power has decreased by 2%. Compare that to, say, a 2% pay cut, but with zero inflation objectively. You're better off in real terms in the second case, but psychologically, the pay cut feels much worse.
That's fascinating.
Yeah. The key insight here is to always think about your returns in terms of what they can actually buy, not just the face value. And he suggested long-term investments in things like stocks and real estate investment trusts, REITs, can be effective ways to try and outpace inflation over time.
Okay, so now that we have a handle on some of these foundational concepts, investing versus speculating, Mr. Market, inflation.
Yeah.
How does Graham guide us in figuring out what kind of investor we should be and, maybe more importantly, how much risk we can comfortably take?
Right. Graham makes a crucial point here. The return you can reasonably expect isn't just about the level of risk you assume.
Which is what most people think.
Exactly. It's also about the amount of effort you're willing and able to dedicate to research and analysis. More effort, potentially higher returns if done right.
Okay.
So to help you determine your own risk tolerance and investor type, he suggests asking yourself some really honest and frankly personal questions about your life circumstances.
Right. What kind of questions are we talking about here? Give us a few examples.
Well, he suggests considering things like, your marital status and your partner's job situation. Do you have kids? Plan to have kids? What about future education costs?
Okay, big expenses.
Yeah. Any potential inheritances coming your way, or maybe responsibilities for supporting aging parents? What about your own career stability? If you're self-employed, how long have you been doing it? How secure is it?
Hmm.
Do you need income from your investments right now? And perhaps most critically, what's your personal capacity, both financially and emotionally, to actually handle potential investment losses?
That last one's key. How would you feel if things went down?
Absolutely.
It-
These are deeply personal factors that shape your investment timeline and your comfort level with risk. The actionable takeaway is simple. Align your investment strategy with your individual circumstances and your genuine risk tolerance, not what you wish it was.
Okay, so after taking that good hard look in the mirror, and let's be honest, likely realizing you lean more towards the defensive investor camp.
Which is most people.
Yeah, most people. What kind of strategies does Graham recommend for them? Keep it simple, presumably.
Pretty much. For the defensive investor, Graham advocates a relatively simple and balanced approach. Basically, dividing your investment funds between high-quality bonds and high-quality common stocks.
No. Stocks and bonds? Pretty standard.
Yeah, but he even suggests a flexible approach to this allocation. Maybe increasing your stock holdings when the market seems low and reducing them when it appears overvalued.
Market timing. That sounds tricky for a defensive investor.
It is tricky, and he acknowledges that, which is why he also suggests that for many defensive investors, the most practical and time-efficient strategy might simply be to invest in well-diversified mutual funds or ETFs, index funds, basically.
Oh, okay.
Yeah.
Let the fund handle the diversification and selection.
Exactly. The key insight here is prioritizing simplicity and diversification for those who don't have the time or, frankly, the inclination for active management.
Right. But for those defensive investors who do want to pick their own stocks, maybe they enjoy it, he lays out some pretty specific criteria, doesn't he? Almost like a checklist for quality.
He does. Very specific. Graham provides 7 key criteria for stock selection for the defensive investor. Ready?
Lay on us.
Okay. First, the company should be of adequate size. Generally, you want to steer clear of smaller, potentially more volatile companies, big, established players.
Okay. Makes sense. Less risk.
Second, it needs to be in strong financial health. Really strong. For industrial companies, he suggests current assets should be at least twice the current liabilities.
Wow, twice.
Yeah, a 2-to-1 ratio. And long-term debt should not exceed the net current assets or working capital. For public utilities, the guideline is a bit different. Debt-to-equity ratio of no more than 2-to-1.
Okay, so very focused on low debt and lots of readily available assets.
Absolutely. What's insightful here is Graham's focus on these tangible, measurable indicators of financial stability. Very conservative.
Those are some pretty conservative financial rules. What else makes the cut for the defensive investor stock list?
Okay, third, the company should have a consistent earnings history. Specifically, positive earnings for each of the past 10 years. No losses in a decade.
10 years, okay.
Fourth, a solid dividend record. He liked dividends, uninterrupted dividend payments for at least the last 20 years.
20 years of dividends. That narrows the field.
It does. Fifth, a track record of earnings growth. Not just stability, but growth. He aimed for a minimum 1/3 increase in per-share earnings over the previous 10 years. And he calculated that by comparing 3-year averages at the beginning and end of that period to smooth things out.
Okay, so stability, dividends, and some growth.
Right. These criteria really highlight Graham's emphasis on finding established, profitable, and shareholder-friendly companies with staying power.
We're getting into some pretty specific numbers here, especially with the financials.
Yeah.
What about the price? How much should you actually pay for these seemingly great stocks?
Price is key. That's covered in the final 2 criteria. Sixth, a moderate price-to-earnings ratio, or PE ratio. He suggested no more than 15 times the average earnings over the past 3 years.
15 times earnings. That's pretty low by today's standards for many stocks.
It often is, yeah. And seventh, a moderate price-to-book value ratio, or PB ratio, not exceeding 1.5 times the most recent reported book value.
Price relative to the company's net assets.
Exactly. However, Graham offers a little bit of nuance here. He suggested that if the PE ratio is particularly low, say well below 15, you might allow for a slightly higher price-to-book value.
Okay, a bit of a trade-off.
Kind of. His overall guideline was that the PE ratio multiplied by the price-to-book ratio should ideally not exceed 22.5. So PE of 15 times PV of 1.5 gives you 22.5. If PE was, say, 10, you could go up to a PV of 2.25.
Okay, that makes sense. So a combined check.
Right. The key insight here is Graham's relentless focus on not overpaying, even for what seemed like the highest quality companies. Value is paramount.
Those are some really clear, if demanding, guidelines for building a defensive stock portfolio.
Now, how does the approach differ for the enterprising investor? Their criteria are a bit less strict, right? They're doing more work.
Yes, exactly. The stock selection criteria for the enterprising investor are indeed less stringent. It reflects their willingness and assumed ability to conduct more thorough research and potentially take on slightly more perceived risk in pursuit of potentially higher returns.
So what do their rules look like?
For financial health, they still want strength, but the bar is slightly lower, maybe current assets being at least 1.5 times current liabilities instead of 2 times,
Right.
and debt not exceeding 110% of net current assets for industrial companies. Still conservative, but less so.
Right.
They also want to see earnings stability, but maybe no losses in the last 5 years instead of 10. Some current dividend payment is good, but maybe not 20 years uninterrupted. A history of consistent earnings growth is still important.
And price-wise, they might look for situations where the price is less than 120% of the company's net tangible assets. So buying close to asset value.
Okay, still value-focused, but maybe looking at slightly different kinds of situations.
Exactly. The key insight is that the enterprising investor has more flexibility. They can analyze and invest in companies that might not meet the very strict defensive criteria, but which, after careful study, still offer compelling value. Maybe turnaround situations or less obvious opportunities.
Interestingly, even with these more flexible criteria for the enterprising investor, there's a really valuable tip in there for all investors you mentioned about where to potentially find interesting opportunities. Something about looking down, not up.
That's right. It's a great point. Graham points out that many experienced professional investors, the really savvy ones, often start their research process by looking at stocks that have recently hit new 52-week lows.
So looking at the losers list seems counterintuitive.
It can seem that way, but it's a classic contrarian approach. It suggests that significant price declines can sometimes, not always, but sometimes present attractive entry points for value investors who are willing to roll up their sleeves and do their due diligence.
See if the baby got thrown out with the bathwater.
Precisely. The actionable takeaway for everyone, defensive or enterprising, is to not necessarily shy away from stocks that have been beaten down. Don't automatically assume they're bad companies. Instead, see if the market has overreacted and if the underlying business still holds value at that lower price.
Good point. So whether you're aiming for a defensive or enterprising approach, at some point you might need to analyze individual securities, bonds, preferred stocks, common stocks. What does Graham say about specifically analyzing bonds and preferreds? Seems less glamorous than stocks.
Maybe less glamorous, but critical for capital preservation, especially for defensive investors. When analyzing bonds, Graham emphasizes that the primary focus should be on safety, specifically the company's ability to consistently cover its intraday payments.
How much cash flow covers the interest cost?
Exactly. He recommends examining how many times the company's total interest expenses have been covered by its available earnings before interest and taxes over at least the past 7 years. You want a healthy buffer.
Okay, a coverage ratio.
Right. For preferred stocks, the analysis is similar, but a bit tougher. You need to look at the company's ability to cover both its bond interest payments and its preferred stock dividend obligations combined, again, over a comparable 7-year period, because preferred dividends come after bond interest.
So you need even more earnings to cover both.
Yes. The key insight here is really assessing the company's financial cushion. How much room for error do they have to meet these fixed obligations year after year?
Okay. And when it comes to digging into common stocks, which is what most people think of,
Hmm.
what's the fundamental principle we keep coming back to?
It always comes back to value versus price. For stocks, the core principle is to always compare your own carefully considered valuation of the company, what you think it's really worth, to its current market price.
The Mr. Market price.
The Mr. Market price, exactly. And Graham strongly advocates for always seeking a significant margin of safety.
There it is again. Margin of safety.
Always. It means purchasing the stock at a price substantially below what you believe its intrinsic value to be. He also cautions, importantly, against relying too heavily on assumptions about the future when you're doing your analysis. Forecasting is hard,
Because the future is uncertain.
inherently uncertain. So making lots of heroic assumptions introduces more potential for error. The actionable takeaway is simple. Prioritize buying at a discount to your best estimate of current value and keep your future projections conservative.
Speaking of valuation, figuring out that intrinsic value, what are some of the crucial elements that the enterprising investor, especially, should really focus on when trying to figure out what a stock is actually worth? It seems complex.
It can be, and it requires effort. Graham highlights several key factors. First, you've got to look at the company's long-term prospects.
The future, even though it's uncertain.
Well, yes, but based on current realities. Does it have sustainable competitive advantages, what people now call an economic moat?
Right. Something protecting its profits.
Exactly. Is it focused on long-term sustainable growth or just short-term gains? And how effectively does it reinvest its earnings to fuel that future growth? That's number one.
Okay. Long-term prospects and moat. What else?
Second, the competence and crucially the integrity of the company's management. You need to look at their track record. Do their words align with their actions?
Do they deliver?
Do they deliver? And are they transparent? Do they acknowledge failures or just trumpet successes? That tells you a lot. Third, the company's financial strength and its overall capital structure. Look for a consistent history of positive cash flow from its core operations, ideally over at least 10 years.
Contingent cash generation.
Yeah. These elements help you assess the quality and the sustainability of the business itself.
Those all make logical sense. Quality of business, quality of management, financial strength. What else does the enterprising investor need to keep in mind when valuing?
Well, linking back to the defensive criteria, a strong and consistent dividend record is still valuable. Ideally, uninterrupted payments going back many years, preferably 20 or more. It shows financial discipline and shareholder focus.
Okay.
The current dividend rate also plays a role in the valuation, obviously. Additionally, a long-term investment horizon is just essential for the investor's mindset. Focusing on the long-term fundamentals helps you ride out those short-term market fluctuations. Ignore Mr. Market when he's being silly.
Patience.
Patience is key. And finally, Graham stresses the critical importance of rolling up your sleeves and carefully examining the footnotes in the company's financial statements.
Ah, the fine print.
Exactly. That's where companies might hide things. Look for potentially aggressive accounting practices, like questionable revenue recognition methods, or maybe improperly capitalizing expenses instead of expensing them.
Stuff that makes earnings look better than they really are.
Precisely. Scrutinizing those details, the footnotes can reveal a lot about the true health, or lack thereof, of the business. Takes effort, but it's vital.
Now, we've touched on it quite a few times, but let's really zero in on what Graham means by margin of safety. You said it's the cornerstone. It sounds like this is the absolute bedrock of his entire investment philosophy.
It truly is. You can't understand Graham without understanding margin of safety. It's essentially the difference between your calculated estimate of a company's intrinsic value, what it's worth, and the actual price you pay to acquire its stock.
The discount.
The discount, exactly. Graham firmly believed, and wrote repeatedly, that the purchase price is the single most critical factor in determining your ultimate investment success. More important than picking the best company sometimes.
So the bigger the bargain you can get on a fundamentally sound company, the better off you are. It seems simple.
It sounds simple, but it's profound. A significant margin of safety acts as a crucial buffer, a cushion. It can make even a reasonably good company, maybe not a superstar, a potentially great investment if you buy it cheap enough. More importantly, it provides that cushion to protect you against unexpected negative events stuff happens. Or, just as likely, errors in your own analysis. Because, as Graham wisely pointed out, accurately predicting the future with certainty is simply impossible. Nobody gets it right all the time.
So the margin of safety covers your mistakes.
In large part, yes. It makes the need for precise forecasting much less critical. The key insight here is that you're not aiming for pinpoint accuracy in your valuations, which is probably impossible anyway. You're aiming for a comfortable margin of error, buying value with a buffer.
And he connects the absence of a margin of safety, or ignoring it, to some of the most common mistakes investors make, doesn't he? How people lose money.
Absolutely. He saw it happen time and time again. One of the primary reasons why investors experience significant losses is by doing the opposite. Purchasing lower quality stocks or even good stocks at inflated prices during periods of market optimism. Euphoria.
Buying high.
Buying high without any real margin of safety to protect them when market conditions inevitably change or when their rosy assumptions prove incorrect. Furthermore, Graham emphasizes that diversification, not putting all your eggs in one basket, is also a key aspect of a broader margin of safety strategy,
How so?
because it increases the overall probability that your portfolio as a whole will achieve satisfactory returns over the long run, even if one or two individual investments don't pan out as expected. It smooths the ride and protects against single stock blowups.
So margin of safety in price and margin of safety through diversification.
You got it. The actionable takeaways are clear. Always prioritize buying at a discount to intrinsic value, and always diversify your holdings appropriately for your situation.
Okay. Finally, near the end of the book, Graham distilled his vast experience and knowledge into a set of 11 rules or maybe guidelines for security analysts and investors. Can you give us just a quick rundown of the main ideas behind these guidelines? We don't need all 11 verbatim.
Sure, it's sort of a summary of his valuation approach. They cover things like consistently estimating a company's average earnings power over a meaningful period, like 7-10 years, not just last year's number.
Looking through the cycle.
Exactly. Making necessary adjustments to past earnings figures to account for significant changes in the company's capitalization, like big share buybacks or issues. Using a reasonable range for the earnings multiplier, the PE ratio. When valuing a company, Graham suggested something in the range of maybe 8 to 20 times average earnings, depending on quality and prospects.
Sensible range.
Right. Considering a company's asset values, particularly its net current assets minus current liabilities, as a potential floor or anchor for its valuation. Being mindful of and appropriately handling unusual or non-recurring events that might skew the reported earnings figures.
One-offs.
Yeah, like big restructuring charges or gains from selling assets. Allocating value correctly among the different types of security holders. Bondholders get paid first, then preferreds, then common shareholders get the residual value.
Understanding the capital structure.
Vital. Recognizing that appraisals of fixed assets, like property, can have limitations, especially when a company has a lot of debt or preferred stock ahead of the common stock. And primarily using those appraisals as a significant factor only when they differ materially, like way higher or lower, from the value implied by the current market price.
Okay.
Ultimately, these rules, these guidelines, they all steer investors toward a more disciplined, rational, and fundamentally based approach to determining a company's intrinsic worth. Less emotion, more business sense.
And Graham leaves us with a really powerful concluding thought, doesn't he? One that really ties his whole philosophy together beautifully.
He does indeed. It's probably his most quoted line after Mr. Market. Graham reminds us quite simply that investment is most intelligent when it is most business-like.
Business-like.
Yeah. His fundamental message is that when you buy a stock, you aren't just buying a ticker symbol that wiggles on a screen. You are becoming a part owner in a real business. An owner. And adopting the mindset of a prudent business owner, focusing on the long-term health, profitability, and value of the enterprise you partly own, that is the key to intelligent investing.
So just to quickly recap the really crucial takeaways we've covered today from Graham. Understanding that vital distinction between investing based on analysis and speculating based on hope. Recognizing the often irrational but sometimes opportunistic nature of Mr. Market using his moods, not being used by them.
Right.
The absolute necessity, the cornerstone of building a substantial margin of safety into your investments by buying below intrinsic value.
Crucial.
And understanding those two distinct but equally valid paths, the simpler, safer route of the defensive investor and the more demanding, research-intensive path of the enterprising investor.
Yeah, knowing yourself and choosing the right path for you. So our call to action for you, the listener, is really to take some time, reflect, think about your own current investment strategy or lack thereof. Consider how Benjamin Graham's timeless principles from 1949 that are still relevant, might apply to your own financial decisions. And, we strongly encourage you, if this sparked your interest, to delve into The Intelligent Investor itself for a much, much deeper understanding. We've only scratched the surface.
Absolutely. Read the source. And finally, a thought-provoking question to leave you with. In a financial world that often seems completely fixated on quick returns, hot tips, and fleeting trends, how can embracing a patient, disciplined, and rigorously research-driven approach to investing, just as Benjamin Graham advocated all those decades ago, how can that become your most significant and enduring competitive advantage?
Something to think about.
Definitely. Thanks for taking the deep dive with us.